Booyah! Let's talk bonds, baby. Bonds are like the reliable workhorses of your investment portfolio. They may not have the flash of high-growth stocks, but they offer something even more valuable: stability. Think of bonds as loans you make to governments or corporations. You lend them your money, and they promise to pay you back with interest. It's a win-win. You get a steady stream of income, and they get the capital they need to grow. Bonds are crucial for balancing out the riskier parts of your portfolio. When the stock market throws a tantrum, your bonds are there to cushion the blow. They're the steady hand that keeps your investments on track. Short-term bonds are like parking your money in a high-yield savings account. They provide a temporary home for your cash, offering a balance between safety and returns. Think of it as a financial pit stop where your money can rest and grow without taking on too much risk. They offer a safe haven for your cash while still earning you a decent return. Unlike a regular savings account, these bonds can provide a higher yield, making them an attractive option for those looking to maximize their short-term savings. These bonds typically mature in 1 to 3 years, making them ideal for short-term financial goals. Whether you're saving for a down payment on a house, planning a vacation, or just want to have a cushion for unexpected expenses, short-term bonds can be a smart choice. One popular example: U.S. Treasury bills or T-bills. These government-backed securities are a favorite among conservative investors because of their reliability and low risk. These bad boys are backed by the full faith and credit of the U.S. government, making them about as safe as you can get. When you invest in T-bills, you're essentially lending money to the government, which promises to pay you back with interest. They might not make you rich overnight, but they'll protect your principal and help your money grow slowly and steadily. It's like planting a tree. It takes time to see the growth, but the results are worth the wait. Another option is short-term corporate bonds. These are issued by companies looking to raise capital for various projects and operations. These bonds offer a slightly higher yield than treasuries, but they also come with a touch more risk. The higher return is a trade-off for the increased risk, as companies can default on their debt, unlike the government. Just remember to do your homework and choose bonds from companies you believe in. Research their financial health, industry position, and future prospects. By making informed decisions, you can enjoy the benefits of higher yields while managing the risks effectively. Long-term bonds are like the marathon runners of the bond world. They mature in 10 years or more, offering the potential for higher returns but also exposing you to more risk. Think of long-term government bonds like the illustrious 30-year Treasury bond. These bonds offer a higher yield than their short-term counterparts, but their prices can fluctuate more dramatically. Why? Because interest rates can change a lot over a decade or more. Then there are long-term corporate bonds. These can be a bit like riding a bucking bronco, exciting but potentially risky. They typically offer the highest yields in the bond market, but they can also lose value quickly if interest rates rise or the issuer runs into trouble. Interest rate risk is the biggest threat to any bond investor. It's a fundamental concept that every bond investor needs to understand thoroughly. It's the risk that rising interest rates will cause the value of your bonds to fall. This is because bond prices and interest rates have an inverse relationship. Here's the deal: when interest rates go up, the value of existing bonds goes down. This happens because new bonds are issued with higher yields, making the older ones less attractive. Why? Because investors can now buy new bonds with higher yields, making your old bonds less attractive. This is a crucial point to grasp for anyone looking to invest in bonds. Short-term bonds are less sensitive to interest rate swings. They offer a level of stability that can be very appealing, especially in a volatile market. They mature quickly, so you'll get your principal back sooner and can reinvest it at the new higher rates. This quick turnaround can be a significant advantage. Long-term bonds, on the other hand, can take a beating when interest rates rise. Their longer duration makes them more susceptible to interest rate risk. Imagine this: you buy a 30-year bond with a 3% yield. It seems like a good deal at the time, but then the market conditions change. Then interest rates skyrocket to 6%. Suddenly your bond's yield looks pretty unattractive compared to the new bonds being issued. Your bond is now stuck with a measly 3% yield while everyone else is enjoying 6%. This can be a frustrating situation for any investor. Not a pretty picture, right? This is why understanding the dynamics between short-term and long-term bonds is essential for making informed investment decisions. The key to mastering your bond portfolio is finding the right balance between short-term and long-term bonds. It's all about managing risk while maximizing your returns. Think of it like building a house. Short-term bonds are your foundation, providing stability and security. Long-term bonds are your roof, offering the potential for higher returns but also exposing you to more risk. A good rule of thumb is to match your bond investments to your time horizon. If you need the money in a few years, stick with short-term bonds. But if you're investing for the long haul, like retirement, you can afford to take on more risk with long-term bonds. Section 6. Navigating market volatility, the power of diversification. Remember, diversification is your best friend. Don't put all your eggs in one basket, especially when it comes to bonds. Spread your investments across different types of bonds, maturities, and issuers. This will help reduce your risk and protect your portfolio from market swings. Think about it. If you only invest in long-term corporate bonds and interest rates spike, your portfolio could take a serious hit. But if you diversify across short-term bonds, government bonds, and corporate bonds, you'll be better protected from losses. Section 7. Matching your bonds to your time horizon. When building your bond portfolio, always keep your time horizon in mind. This is the amount of time you plan to hold your investments before you need the money. Short-term bonds are perfect for goals you're saving for in the next few years, like a down payment on a house or a new car. Long-term bonds, on the other hand, are better suited for long-term goals like retirement or your kids' college education. Remember, the longer your time horizon, the more risk you can afford to take. If you're investing for decades, you have more time to recover from market downturns. But if you need the money soon, you'll want to play it safe with short-term bonds. Section 8. Bonds aren't just for retirees. Benefits for all investors. Many people think bonds are just for retirees, but that's not true. Bonds can be a valuable addition to any investor's portfolio, regardless of age. Young investors can use bonds to balance out the risk of their stock investments. Middle-aged investors can use bonds to protect their savings and generate income. And retirees can use bonds to create a steady stream of income during their golden years. No matter your age or investment goals, there's a bond out there for you. Don't be afraid to explore your options and find the bonds that fit your needs. Section 9. Understanding bond risks. Your key to fixed income success. Bonds are often seen as a safer investment compared to stocks, but it's important to remember that they come with their own set of risks. In this section, we'll delve into the various risks associated with bonds and how you can navigate them to ensure a successful, fixed income investment strategy. Bonds may be less risky than stocks, but they're not risk-free. While they offer more stability, they still carry potential pitfalls that every investor should be aware of. Understanding these risks is the first step in making informed decisions that align with your financial goals. Before you dive headfirst into the bond market, it's crucial to understand the risks involved. This means taking the time to educate yourself about the different types of risks and how they can impact your investments. Knowledge is your best defense against potential losses. We've already talked about interest rate risk, but there are other risks to consider, like inflation risk and credit risk. Each of these risks can affect your bond investments in different ways, and it's important to understand how they work. Inflation risk is the risk that inflation will erode the purchasing power of your bond payments. This means that even if you receive regular interest payments, the value of those payments could decrease over time if inflation rates rise. Credit risk is the risk that the issuer of your bond will default on its debt. This can happen if the issuer faces financial difficulties and is unable to make the promised interest payments or repay the principal amount at maturity. The best way to mitigate these risks is to do your homework. Research different bond issuers, compare yields, and assess their credit ratings. Look for bonds issued by companies or governments with strong financial health and a good track record of meeting their obligations. And choose bonds that fit your risk tolerance and investment goals. Remember, knowledge is power. The more informed you are, the better equipped you'll be to make decisions that align with your financial objectives and risk appetite. The more you understand about bonds, the better equipped you'll be to make smart investment decisions. By taking the time to learn about the different types of bond risks and how to manage them, you can build a more resilient and successful investment portfolio.